Hello, everybody, and welcome to the first session, which is a focus on innovation in wealth tech. We'll be looking at how wealth management and private banking has been transforming in the coming years, and we'll hear from our expert panel. My name is Musheer Ahmed. I am the founder and managing director of FinStep Asia. Along with that, I am co-founder of Virtual FinTech Fair and as well as of the FinTech Association of Hong Kong. So welcome to our panelists here. I will request you to briefly introduce yourselves before we jump into the first question. Let's start with Julie.
Good afternoon, everyone. Thank you, Musheer, and thank you, AFO and Virtual FinTech Fair for giving me the opportunity to join this panel today. I'm Julie Chan. I'm a PwC consulting partner here based in Hong Kong. I have a focus on wealth management industry. And I'm very passionate about helping my clients achieve their digital transformation goals. So I'm looking forward to sharing my perspectives with the audience today. Thanks.
Thank you, Julie.
Good afternoon, everyone. Damien Mooney. I work here at BlackRock, and I oversee our wealth technology business, where we try and help our wealth management partners transform the business through technology.
Thank you, Damien. Mr. Ananda?
Yeah, hi, my name is Ananda Bhaumik. I've been working for 40 plus years in the areas of banking and treasury and wealth management, and I recently retired, but I'm active in the area of advising a few tech companies, including one involved in digitizing trade finance. And I'm very passionate about the use of technology in wealth management. Looking forward to a great discussion.
Thank you. Karen?
Hello, everyone. My name is Karen Contet. I'm the CEO and co-founder of AngelHub. We are the first SFC licensed startup investment platform here in Hong Kong, and we want to democratize investment into tech companies. I'm really looking forward for the discussion.
Thank you, Karen, and thank you, everybody, for joining us. We've looked at this space for a while, and we're seeing quite significant transformation taking place, not least because of COVID and other things. To start off with, I would like to ask Ananda and Julie, wealth management and private banking has typically been high touch, and we've seen that changing over time, but what has been traditionally the role of technology over the years? How have you found that? Ananda, would you like to start?
Sure. You used two words, high touch and technology. See, for the ultra high net worth space, it will remain high touch probably forever. If a multi-billionaire comes to me, for example, and gives me $1 billion worth of shares and asks for a 20% loan to value or a $200 million loan, even I know that it cannot be done over email. Of course, it'll be much less or even zero touch at the mass affluent end. But one thing to remember is that millennial investors, even at the ultra high net worth end, who would be receiving trillions of dollars in one of the largest wealth transfers in history, are more tech savvy than their parents and grandparents. So PBs would have to cater to them as well. So most likely it will be high touch and high tech approach at the very high end of the wealth spectrum. Now, technology's role, the other question you asked, has always been that of an enabler. Historically, it was focused on supporting the internal needs of PBs. It's only lately that the client-facing aspect, from onboarding to two-way communication, has been receiving some sort of attention. PBs and WMs were sort of chugging along, digitizing a process here, making client onboarding a little more friendly, etc., until COVID-19 came in, and it accelerated the adoption of a slew of tools like digital communication tools, secure chats, encrypted messaging, remote video conferencing, and electronic signatures, for example. Other than relationship and communication, where the client has, say, 24/7 access to his portfolio, can trade off his handheld or desktop, has a choice of calling his banker via voice or video, aggregation of reporting is one area which multi-banked ultra-high net worths are demanding right now, and PBs are rushing to provide that service. Now, the aggregation bit is nothing new, but the service was mostly confined to financial assets, and it was a bit manual. The whole process was manual to a large extent. The big change is that along with publicly and privately traded assets, Aggregation now includes non-financial assets like the client's collection of classic cars and horses. In short, wherever a price is available, consolidation is possible. But the real change that is taking place a little bit slowly is in the area of customization of offering. Let me use the word super customization. Now, what exactly does a client want or a client need? Historically, this understanding was delivered by the private banker, me. Based on this knowledge, customization was delivered by the PBs. But technology is now changing this to deliver an increased understanding of client behavior. By data mining, for example, client has a 10 to 20-year relationship with a bank. If you can analyze the data, then you understand the client better. Along with this, if you ask a series of intelligently framed questions, then the bank can have an objective understanding of the client's needs. A private banker's understanding, my understanding, was subjective. But if you combine this with the objective assessment, thanks to AI and data analytics, PBs would be able to offer a far superior level of customized service, which includes not only products, that's a very minor issue, but advice on intergenerational wealth transfers, for example, succession planning, and other life events, even anticipating those events and being proactive. And best of all, offering customized pricing. Ultra high net worth pricing has always been customized. But if you have the subjective and the objective assessment together, you can offer a finer customized pricing. This, in my opinion, is a very, very big change. Does it mean there are no pain points? There are definitely pain points. Regulations have been an additional but necessary burden. RegTech is trying to solve that. Simpler issues like suitability, etc., have been automated, but compliance and risk queries are still an issue. I'll give an example. John Williams, a UK citizen, Hong Kong tax resident, is a signatory to an account with me. One fine morning, compliance sends an email saying that there has been a name hit where a John Williams has been arrested for drunk driving in Edinburgh. Though the RM knows, I know, my assistant knows, even the compliance officer knows that these two John Williams are two different persons. But there has been a name hit, and the RM or his assistant has to give a comprehensive reply. I know of an artificial intelligence and machine learning based software in Singapore, which is being trialed by one of the 3 large Singapore banks, which is trying to reduce the name hits by use of AI and machine learning. But by and large, the current crop of software is not that sophisticated. One last tiny point. Same is the case with risk management. In spite of automation of suitability, etc., the final proof that all trades were kosher, is the email sent to the client from the front office. Up to now, I'm not aware of any software that can scan emails to point out irregularities. We know that Google reads our emails, so technology exists. But as of today, it is still a manual process and a burden of sorts in most banks.
But thank you, Ananda. That's quite comprehensive and a good lead. Julie, building on from there, how have you seen that experience? And you have seen a lot of asset managers, private banks that you've been catering to as being a partner at PwC. When you also have your experience there. What has been your experience in terms of how's technology been traditionally used in the institutional, on top of what Ananda shared?
Yeah, well, hard to add on to, actually. Ananda's already given quite a good, clear account and some great examples there. I mean, look, I think just looking back in, the wealth management and private banking industry, the role of technology has really changed, 2 main areas, and just reinforcing some of the points that Ananda made. The client engagement model, and then obviously on the downstream side, the less interesting part is then the automating, digitalization of workflows and downstream processes. But if I can just indulge me a bit on the client engagement model, I mean, obviously that's had to evolve, right? Obviously due to the changing needs, expectations, and behaviors, right, of clients, as Ananda quite rightly outlined. Clients now, no matter which segment you're dealing with, want that sort of consistent, high quality interaction anywhere, anytime, which means you need to have that multi-channel approach. So, if I want to call you in the morning, my client advisor, and I want to check my portfolio, my phone in the afternoon, And when I get home, I want to, be able to see any actions that I've taken throughout the day are reflected, when I look at it on the iPad. So that's really created this huge demand, I would say, for, technology, digital innovation, right? But we're also forcing, I think, private banks to really understand, though, what's the role of technology within each of those client segments, right? So I think, there was a great account from the Ananda on the, the ultra high net worth, and people often think, well, they still want that very much high touch, but there are absolutely some great examples where clients actually at that level are driving a lot of that innovation, obviously because private banks are very, want to maintain that trust and maintain the relationships, right? And that's why they evolve, right, by keeping up with the changing expectations. Maybe if I'll just comment on, actually where I've seen, and I think that's an underserved market, is that $1 million US, to $10 million US segment, because again, whether they're digital natives or not, they are demanding that fast access. They want products that are also offered to the ultra high net worth segment, but they want that tailored to them. They want the personalization. So how does a private bank then create that platform, gives them that trading, advisory service, gives them the access that they need, but how do they deliver that, right, on a scalable, seamless perspective? This is probably then segue into that second area where I said the whole overall automation downstream processes. Often what I'm seeing is the banks have been quite fast to react to. Sorry, interference on the line. Can you guys still hear me properly?
We can just continue.
Okay, sorry about that. Yeah. Yes, go, Damien. All right. Well, just to finish off on my point, I wanted to say that, where I see a lot of clients, launching those digital touch points, right? So, as a private banking customer, you can probably view on your mobile app, your portfolio. You're probably getting research pushed to you via the app, investment ideas, via the app as well. But actually, when you want to trade or you want to find out more, often you've got to revert to another channel. You may end up having to call your RM, for example. So that actual seamless sort of like end-to-end interaction or end-to-end sort of value chain isn't quite there yet, right? So that clearly is, I think, the next step for technology to enhance.
Thanks, Julie. Damien, coming to you, you are in a position that not only has been looking at the business side, the wealth management side, but you're also heading and leading Aladdin Wealth Tech for BlackRock for quite some time. How have you seen, private banking and wealth management change, and how is fintech changing that? Right, a lot of financial services, as well as on the wealth side, many people are starting to talk about big engineering tech teams and changing their models to look a little bit more like technology firms. So, what are the key areas you see that's transforming and changing in that space?
Thanks, Musheer, and good afternoon, everyone. Look, I think there's a lot going on, but I think we need to differentiate between the light and the heat. And what I mean by that, there's a lot of talk about what is going on in the industry, but actually what's really changing is probably not where I think the average client of a private bank or wealth manager would like it to be. So I think the trend lines are encouraging. And as you mentioned in your opening remarks, Musheer, the pandemic has given many firms the necessary shove to get with the program. I do find the notion of differentiating clients by the service level is becoming a somewhat dated concept as well, because I think everything in the future will be digitized, and whether or not it will be augmented by human will be really a function of whether the private bank is able to economically serve that customer. Everyone would love the personal touch, but I think to Ananda's point, it's only going to be the super wealthy, and frankly, even today's is not getting served by the industry just yet from a technology standpoint through wealth management. It's on the way. So the signs are encouraging. And I think just to build on your question a little bit more, look, I think there's two trends I see going on. I'm happy to dig into these. One is, how is the traditional wealth management industry kind of responding to this need? And what are they doing about their own technology offering? Whether it's how do they think about building buying or renting the capability they need to kind of propel themselves forward, to make themselves future relevant. And I think, which we may come back to, and I'll wrap up here, is how is technology basically creating more opportunities for investors to get access to wealth management products, which is sort of the democratization of the industry. And that's where the fintechs are obviously very well poised to play a very powerful game. So some of my remarks may seem somewhat cynical, but I am old, so I'm allowed to adopt that posture. But genuinely, I think the future is extraordinarily bright for the industry. It's really, really bright for relevant, scalable offerings in wealth tech, because the market is still very much underserved, and technology will be the enabler for growth.
Thanks, Damien. Quite pertinent in terms of what's going to take place, and big institutions do have the resources if they wanted to transform themselves. Karen, you and I come from a trading background, started off our careers as sales traders, getting onto electronic, and then switched to the innovation technology world. And you've been one of the pioneers of the startup ecosystem here in Hong Kong, and now with AngelHub. In your experience, being on the both sides, how have you seen that transformation taking place, and what's your view from an ecosystem perspective on how the industry is transforming?
Hey, thank you. Thank you very much for the question. I think how the ecosystem has been transforming. I mean, you know just well as I do that like just 3 years ago, fintech was just one word regrouping everything. And now we have at least 12 different subsectors just into fintech, right? So we have definitely seen the growth. Just talking about, wealth tech, and just to give a few numbers to put it back into perspective, in 2018, institutional money invested like 4.6 billion into wealth tech. And actually just in Q1 last year, the number was 2.5 billion. So we definitely see the growth in terms of investment into it. And the ticket size moved from like 4 million to an average of 25 million US dollar. So there is definitely a lot of companies into the space, and also a lot of investors and institutional investors that actually believe into it. So I think tech is definitely, as we say, the enabler. It's all about, okay, how can you give access to an investor to the right product in like just 5 minutes? Having a digital onboarding is definitely key. It took a little bit of time here in Hong Kong to get it approved. So unfortunately, when we're talking about globalization, I wish we could say that regulation was global and was the same everywhere, which is still not the case, and it's actually the biggest hurdle for tech companies to grow. So I think one of the key advantages that big institutions have over fintech companies is that usually they are global and they access a lot of market, which actually takes a lot of time for fintech due to regulation. So that's one area of collaboration that can be key with fintech companies as well. And that's why I think, we're always talking about competition, but there is actually a lot of collaboration because these big institutions invest into these companies. So of course, these big institutions, they have a lot of tech departments, but can they be as fast and as agile than the fintech company to develop actually this new user experience for clients? And that's why we see all the collaboration.
Julie, I'm going to bring you in here. Some of the areas, Ananda, and you spoke about, which are ripe, we talk about that transformation. And Karen's bringing up a very good point about the amount of money that has gone into wealth tech over the last few years. But then that's not even a drop in this mighty ocean of trillions of dollars that are being managed by the large asset managers, right? And they have, if not doubled, gone up much more than that over the last 10, 12 years since the GFC. Just means the wealth has grown and asset managers managing money is also grown. Right? I mean, BlackRock's technically, if you look at their asset under management, they would be the third largest GDP in the world, right? If we had to look at it. So what are we seeing from their investments overall in the industry for the transformation? And do you see them adopting a model which is going to be a modular approach, which digital banks are looking to do? Or are you going to see a different model for them to come up with?
Yeah, well, we're talking about wealth management, private banking industry. The pace of change, I would say, even within financial services is maybe I would say often lagging a little behind from some of the other financial services companies. But look, I think in terms of introducing other models, I'd be really excited to see partnerships, and I hope there'll be some fruits of partnerships between some of the digital banks, the virtual banks, with private banks, for example, so that we can really create, new innovative products, right, for the Hong Kong community, and really change the way that Hong Kong consumers grow and interact, with their wealth, right? I mean, I think ultimately that's what's that's what I think if partnerships can achieve that. I think bringing it close to home, in terms of what are some of the areas that I would still say that are still ripe for transformation. I mean, for a private bank, it's going to be productivity, right? It's always going to be productivity for their client advisors. So I think investment into that has to be key, right? That is around taking some of the, mechanical, let's say, or manual tasks of portfolio construction, for example, right? And being able to automate that so that you can generate those ideas on a more timely basis and provide that enables then investment decisions to be made much faster, much quicker, right? From that perspective, and focus on those value-added tasks by the client advisor than having to look at the manual processes and also downstream. So that, I think, from a disruption standpoint or a transformation still to be had, I'd say that's the number one area. And then clearly, as I've mentioned before, it's being able to create that seamless experience and continue that all the way through down the value chain. And if partnerships, and it's not always just a tech partnership, right? Because private banks might be looking to get into different segments, for example, or may not have the platform ready to service those segments. So partnerships can mean technology, but also client acquisition. How do you continue to grow that base? So I think, I'm looking forward to seeing some more models appear over the next few years.
Thanks, Julie. Ananda, your viewpoints on this? Would you have any comments on how you see this changing?
I would just say, look, I think the comments that Julie made are all fair and valid. I think the challenge factor is we're just at a very nascent stage. So I would find it difficult for us or anyone in this panel to point to really scalable success stories just yet. So I think we are at the beginning of, again, just to go back to hopefully my optimistic comments, I think we're at the beginning of that inflection point. We are going to see some massive changes. And frankly, part of it's been held up by regulation, but to be frank with you, most of it's been held up by the incumbency of the big players. Because it's not really in their interest to cannibalize what is a very, very margin-rich business, which at the moment is not really under any kind of existential threat, certainly from a regulatory perspective. The forward-thinking organizations, and there are many in the industry, are seeing a future where technology will be a central part of the client experience, but also the actual industry will be moving much more away from a transactional model, much more to an advisory kind of service-led model. Because at the moment, essentially what's happening is the industry is funded by the sale of product. And that's fine for now, but it's something that is an evolution. So I think, what Julie's talking about, I think, there's some very, very, some encouraging signs, but we can't yet, certainly outside of mainland China, we can't yet point to, truly digitized, scalable offerings just yet. But the signs are promising. That's the only thing I want to caveat, because I just don't want us to get ahead of ourselves. I mean, it's exciting, but we are at the early stage. But we're directionally going in the right direction.
From a private banking side, how are you seeing that grow? You brought in the intergenerational transfer of wealth that is going to take place, but we're also talking about longevity, where people are going to be living for, average lifespan in Hong Kong is 89 for women, 86 for men, and likely to increase. So even if there is traditionally that may have happened at the ages of 60, 70, and now those transformations or the wealth transfers are taking place at ages of 80 plus. So how do we see the technology play coming in, even though the millennials are more savvy for private banking?
Look, it's a difficult question to answer. In the West, in Europe, for example, where wealth has been there for a few hundred years, the transfer of wealth is a process which is sort of built in a way. But in Asia, where the patriarch is 80 to 90 years old, still is holding on to the wealth transfer, it takes place at a much later stage, and the approach here would be different. But You are talking about disruption in private banking, right? I think the entire chain of processes, internal to client facing for PBs, is up for disruption. Also, any part of service provided by a PB, private equity, for example, where the costs are high, are up for disruption. Solutions are there in some form or the other, and Damien has mentioned that some of these are evolving. The software, for example, including AML and KYC, the solutions are evolving and they're not perfect. And whether a PB needs it immediately or not depends on the cost and the benefit derived. I see three disruptions coming from three fronts, which was touched upon a little while ago. The first threat is from existing tech players like Apple, Amazon, and Microsoft, who emphasize privacy probably more than, say, Google or Facebook. The second threat is from ground-up digital banks, which have been licensed around the world. Now, big tech has the advantage of size. Their market cap is several times the largest financial institution. They have cutting-edge technology. They have brand recognition. They have trust to a certain extent. If Apple started selling financial services, I'll probably trust Apple with my money more than a new bank. And also, they're sitting on a humongous amount of data. Wealth managers who deal with a mass affluent end, they face more threat than the private banks. Also, these tech companies may act more like a marketplace to start with, selling BlackRock ETF products or whatever. So the private banks have some time to catch up. Now, as for the digital banks, I think the challenge is a little exaggerated. Think about it. They will have an impact at the mass affluent end, but they also suffer from the disadvantage, as of today, of onboarding clients in a single jurisdiction, unlike PBs who can take on cross-border clients within limits. So these new wealth managers will be more effective in countries with large population, let's say China, India, the US, Indonesia, for example, compared to already crowded markets like Singapore and Hong Kong. And we must not forget that they will be subject to the same rigorous regulatory conditions that PBs and WMs are currently subject to. The third, and this I think is the largest threat to all the private banks, is from tokenization. Briefly, we know that it is a form of securitization, but is a blockchain-based token that is a digital representation of a tradable asset. Benefits are huge. The biggest advantage is the ability to liquefy an illiquid asset. In Asia, we know up to 60% of a person's net worth is in real estate across the wealth spectrum. If such an illiquid asset can be tokenized and traded, it will release trillions of dollars of liquidity. It will see huge investor interest, and in turn, the increase in liquidity premium, which will take place, effectively will capture greater value from the underlying asset. A tokenized asset can be sliced into small portions. I can own 1,000 Hong Kong dollar piece of a prime office building in Hong Kong if the owner of the building is willing to tokenize it. Very important thing from private bankers' point of view. Private equity, if a client with me had private equity and the client decides to go to another bank, he cannot remove the private equity as of today to the other bank. It's impossible. But if it is tokenized, just imagine it'll be instantly transferable. And because the tokens are more secure and with an indelible, what the word they use is immutable record of ownership, and they are digital, they can be transacted at a lower cost. Imagine what it would do to the margins in private equity. And herein lies the challenge from tech companies. Most tech companies are holding patents on the technology, and if they choose to muscle into this area, they will give PBs a run for their money. As for collaboration, banks have no choice, but have to collaborate. Private banks have no choice, have to collaborate with fintechs, buy fintechs, as it was mentioned, or just collaborate with, let's say, Microsoft in some areas to provide digitized services. So in my opinion, this is a far greater threat than anything else. We can talk about how private banks can sort of get out of this, in the sense that how can they become challenger bank themselves. DBS is trying to do that in Singapore right now as we speak. We can talk about it later if time permits.
Thanks, Ananda. Karen, Damien, you wanted to make a point here?
Oh, no, I just wanted to chime in a bit again. I'd like to try and disagree, not for the sake of it, but I think it hopefully will make it more entertaining for our viewers. But I do agree with some of Ananda's points, and there's no question. I'm by no means an expert in tokenization, but I do agree the liquefaction of illiquid assets into more accessible units is an essential part of opening up the market. And look at what firms like we and others have done around ETFs, and how we've just basically brought an investment technology to the investment market to give people access to difficult to access public market securities in this case. So I think the future in tokenization is, again, it's very bright but very, very early stage. I would, however, take a slightly different view, just for the sake of it, forgive me, on the other aspects of disruption. Me as an Amazon Prime customer, or me as an Apple customer, me getting a statement from Apple Finance or Investments saying, I have lost money on my investments. I'm not too sure how that resonates with their brand. I mean, apart from that it's super regulated, but the notion that they're going to try and muscle in a market where there's an inherent risk and run the risk of disappointing people, I think is a non-trivial consideration for the brand proposition. It's not to say they wouldn't consider it, but I do think, aside from the regulation, this notion of how does that work to help with their client goals, I think is something that I'm sure they've given lots of thought to, and clearly it's quite an intimidating prospect of all the data they have. But in reality, it's not that I'm complacent, but I think that is a big step, and I think the brand trust could be eroded pretty quickly, depending on markets. And we have to remember, back to the earlier remark, we've had 12 years of a bull market. Everything's been buoyed up. I think it was Musheer that mentioned that. There's been a lot of beat in the market. It's kind of been easy, relatively speaking. But I think that's not necessarily the forward game. And then the other part about the virtual and digital banks, which again, I've opened accounts at all the ones I can because I want to see what they're like and try them. But I think the acquisition of customers, again, is going to be a significant challenge for them as well. So I would imagine some of these players will ultimately get acquired by the traditionals further down the track. For what it's worth, personal views, but just wanted to share them.
Right. I think it's a good point. I'm bringing Karen on two folds. Right. One is on Ananda's point about democratization, newer models. AngelHub has gone through the whole process of getting a regulated license, the first one in Hong Kong for your investment platform, right? And that's more innovative in this part of Asia, or in Asia for that matter. So I wanted to get your views on that, on the regulatory side of what you're seeing. And on the other side of things is we recently, yesterday, in fact, had an announcement when it came to Ant Financial, and you've also seen globally regulators coming in and bringing in more scrutiny, oversight for technology firms in financial services, right? Going to Damien's point as well, there is the issue of usage, there is the issue about trust and stickiness, and about the brand image itself. So how do you see both of these being balanced, where on one end you want innovative products and you need to bring them in, while you also need regulations to have strong oversight on anything to do with customers?
So I think, first of all, some people call it a threat, others call it an opportunity. So I think it really depends where you stand. Then regarding regulatory side, I think it's good to have new players coming in the market and offering new type of investment products. And this challenges people that have always, look at all the different banks. Usually sorry guys, but usually they offer all the same type of products, right? It's like the only differentiation is it's like 1%. So having someone that can come and challenges with new products, or having a lot of different type of fintech companies that can come with new different offering, I think it's really good, and it's good for the end user. So that's key. Regulation is definitely key, especially for all these new players, because, for example, just like us, we are a new platform, we are regulated by the SFC. So basically we comply with regulation as any other regulated entity. And this is very important in order to build the trust with the customer that is, giving us also their money, right? So I think that's definitely key. In terms of having the tech company under the scrutiny of the regulators, I think it depends on which country you're referring to, but I think they have always been, usually on this part, or in Europe as well, and in US. And it's good that they are here. Actually, it's always a good point. Sometimes you just want them to be moving a little bit faster, but some things do take time.
Thanks, Kat. I'm going to bring Julie in, and in part also answering one of the questions that the audience has put. A lot of our audience are from the family offices side, right? Some of them are also from single family office. What are you seeing from their perspective in terms of digital transformation and use of technologies like AI, etc.? We'll see some solutions at the end of the event today at 7 p.m. But what are your views in terms of how family offices, in particular single family offices, are responding to this?
Yeah, I mean it's an interesting question, and I would say, as a single family office, if you've taken the approach of perhaps, I don't know, you could be leveraging a private banking infrastructure, right, for your area, or you could have developed your own. And I think, there's different levels of maturity, right, from for the single family offices all the way up to obviously the multi-family offices. But for them, I mean, because of the diverse range, right, of investments for the family offices, I think the key challenges, and we often, as PwC, we do have a very healthy assurance practice that serves a lot of the family offices, but then actually helping them to aggregate and consolidate and manage and get that timely reporting, I think, is one of the areas that we've seen the investments in. I think they'll have core systems, right, and they might be leveraging, and they're working with tech companies around that. Is it innovative? I think for them, it's first of all probably just getting to that level of, let's just say, technology maturity. But of course, they're going to be the ones that maybe perhaps want to go that one step further, might be looking for some more like AI, robo-driven type solutions. And I think that's going to be great. But if I look at the service providers that are out there who are catering, to these various segments, we've seen, yes, a lot of innovation from some of the large players, right, who've expanded beyond the core banking systems into the, CRM, data analytics solutions. I think there's still a lot of room in the market, I think, for tech providers to evolve and have platforms or specific bespoke solutions for the family offices. But I think bespoke is going to be the key thing. Every family office will probably have their own investment philosophy, have their own investment strategy, and their own needs, right? Risk appetite, all of the above, right? So I think, how do you then, as a service provider, service that industry where you have to provide that bespoke, and how do you make that scalable? How do you make that cost competitive? So I think there is a lot of space for innovation, but just general uplift, I think, of maturity across that.
Thanks, Julie. Damien, I'm going to bring you in as we come towards the close. One of the points I want to talk about is about client experience, right? And how is tech solving that challenge? Are wealth techs actually helping the industry evolve? Is there product innovation? Where is the client benefit coming in on wealth tech? What's the change you're seeing, and what should be the main focus?
Yeah, I think I'll try and answer that in the context of probably what would be technology firms that have got a B2B business and they're trying to help, for one, about the traditional industry evolve. I think it was mentioned in the opening remarks that a lot of the technology efforts really sort of been in the core and at the front end. So there's a plethora of very effective, let's call them fintech, rather to Karen's earlier point. There's a lot of subdivisions there. Let's call it broadly fintech offerings, which are helping banks and wealth managers, private banks, solve for front end sort of UX type of challenges or pain points, to help expedite predominantly what I would call either our transactional type of use cases and information delivery to Julie's early point. And then of course there's a ton. It's the classic the place where your career basically ends when you're managing one of those multi-year bank transformation technology projects and it goes off budget and all that kind of stuff. So I think there's been a lot of work going on in that area. I think with regards to sort of wealth technology, which is typically in the area of digitizing sort of the portfolio management, portfolio advisory, investment recommendations, I think that's still, as I mentioned, at early stages, because I think the banks have really had to prioritize. I think there are obviously different private banks which have maybe a much more established discretionary advisory business. But again, probably Ananda would agree with me, every private bank is different in terms of its value proposition, and therefore the impact of so-called wealth tech is variable. So, if you think about where the market is going, which is much, much more to an advisory and discretionary type model where you're either taking advice from the bank and or you're delegating your investment service to the bank. There's a lot of technology that's starting to kick in there around things like managed account, managed investment solutions, and scaling discretionary, and of course the advisory, the so-called robo piece or hybrid robo is taking pace, but off I think off a quite low base. And then as I away from the sort of B2B side, I think there have been a lot of valiant attempts at a sort of a direct to consumer wealth tech model, but again, very early stages, and we may see that hockey stick or inflection point, but it hasn't happened just yet, at least in the context of wealth. I think, again, share trading and other things have been very, very successful. So it's a mixed picture, Musheer, but I think the reality is the industry can't go back; it can only go forward, and it is being propelled by the fact that we're having this fantastic conversation and experience with lots of other people, and it's completely digital and technology enabled. And this is our benchmark for the future. So excited what we can do with the industry, and it's certainly one where there is more investment starting to come in. But I think as we probably get into, if we have time, is that not everyone's going to be a winner. It's going to take, there's going to be a day of reckoning, just as these different things gets filtered and sorted out.
Let me quickly add something to what has been said before and by Damien just now. Banks can sort of attack or mitigate the problems they're facing by taking on an advisory role. When news became sort of free, newspapers like Financial Times basically started saying that we will not provide news anymore. What we'll provide is analysis. So banks have to take on that role, the advisory role, more seriously, which means maybe more discretionary management, which is very new to Asia. In Europe, it's very common. Up to 30-40% of a bank's AUM is under discretionary management, not so much in Asia. But those are two things that to be kept in mind.
Right, we're coming towards the end of the session. So what I would ask each of you is 30 seconds, if you can, keep to that, please, on what for you is going to be the post-COVID most important need for technology post-COVID, right? We hopefully are turning the corner with vaccinations and globally. So what would be for wealth management and wealth tech, what would be the turning most critical element for 2021? Ananda, we'll start with you. 30.
I think the most critical element will be client engagement. We are not going to go back to the old model anytime soon, traveling, hop on a plane just to have lunch with somebody and come back. So I think client engagement, use of digital tools, this is the most important area that banks will be focusing on spending money in 2021.
Perfect. Karen? You're on mute, Karen. The line of 2020. It's still on mute.
Sorry, I couldn't unmute. So I have 15 seconds left.
I'll give you 15.
So basically, as we say, user is definitely at the center. As Ananda said, very clearly at the beginning of the discussion, I think, COVID has shown that an acceleration in terms of digitalization, which is amazingly great. So I think that even post-COVID, it's going to stay as focused on tech, and people know now that we can do a lot of things, thanks to technology. So actually, I think it opens just a lot of opportunities for new companies to grow and do new things as well. So that's quite encouraging. It's quite an acceleration.
Look, fair enough. Thank you, Karen. Damien?
Yeah, maybe building on Karen's points, probably 2 or 3 quick things. One, no more excuses, because, pandemic was the shove that everyone needed. The winners will be the ones who double down in tech, for sure. And, let's design technology for humans, not for advisors, investors. Like just make the tech better, because we still have a lot to improve upon. But I think if the firms are doing those 3 things, are going to be wildly successful in the next 5 or 10 years.
Thank you. Julie, last words with you.
Yeah, like to me, I know this is a digital innovation panel, but like to me, I think tech is actually the easier part. To me, is the digital enablement. So how do you actually create that culture, that environment, right, for organizations and their people actually to embrace and accelerate digital transformation and keep that on a sustainable basis, right? So yeah, to me, tech is the easy part. Actually, it's the rest that's going to really make the difference.
Great. I want to take this opportunity to thank all of you for taking out time from your very busy schedules. Very insightful session, and we think we've covered quite a few points in the 45 minutes we had. So once again, Ananda, Karen, Damien, and Julie, thank you so much again for joining us. And for the audience, please stay tuned. In 2 minutes' time, we will be starting the next session, which will be on the India Wealth Tech, looking at the growth path, a presentation by Medici. So thank you all the speakers, and we will be coming back in a minute. Thank you.